Depreciation. My group members are Leonie Perfit, Rachelle Cornejo, Ramsey Tun, Mary Rekenia, and Carice Cock. What is depreciation? Well, depreciation is an accounting method used to allocate the cost of a tangible or physical asset over its useful life.
So there are four causes of deterioration. Let's start with the first one. The first one is physical deterioration. And physical deterioration comes in two forms. The one being wear and tear, where the assets are eventually wears out, and these consist of vehicles, machinery, and buildings that last very long, and others only a few years. The next form is erosion, rot, and decay. This is where Mother Nature comes to play. Metal will catch rust, the woods will rot, and other equipment will decay without proper attention. The second cause is the economic factor. This is where a business puts down assets that are in good condition because of the two main factors. The first one being obsolescence. This is where society is being advanced. Like technology is growing nowadays, so most people will now not use books for accounting. They will use the software, the computer for their accounting. And the other one is indequency, where the business is the one that grows. So if a business grows and they see more success, they will want to upgrade their equipment and their assets because their business is growing. They won't really need small equipment now because of this. The third cause is the time factor. Alone can cause some assets to lose their value. If they are not used at all, intangible fixed assets like lease, patents, copyrights, etc., will eventually lose their ability to function. The last cause is depletion. When the resources are extracted from certain assets, such as coal mines, metals, and oil reserve, their usefulness and values are diminished. The basis for changing depletion is the amount consumed by the relevant assets. So these are the four causes of deterioration.
In depreciation, we use two methods. One of the methods that we use in depreciation is a straight line method. This method spreads the cost of asset evenly over its useful life. An example of this is a car was bought for 50,000. The business decided to keep it for 10 years and then sell it for an estimation of 5,000. The formula for the straight line method is as follows: asset cost minus salvage value divided by useful life. For the example above, the asset cost is 50,000 and the salvage value is 5,000. The useful life is 10 years. So in order for us to solve, we would take the 50,000 minus the 5,000 divided by the 10 years, which would then give us 5,000 divided by 10, which would then give us our final answer, which is 4,500. We also have another method which is called the reducing balance method. This method applies a constant rate of depreciation to the declining book value of the asset each year. An example of this is a machine bought for 40,000 has an estimated life for 6 years. It is to depreciate at 20% using the reducing balance method and calculate the charge of depreciation in the third year. The formula for reducing balance method is as follows: book value at beginning of year times depreciation rate. For the example above, the depreciation year 1 would be as follows: 40,000 times 20%, which would then give us 8,000. We would then take that 8,000, we then take 40,000 and minus 8,000 from it. which would then give us 32,000. In depreciation year 2, we take the 32,000 times 20%, which would then give us 6,000. We would then minus 6,000 from 32,000, which would then give us 25,600. In the depreciation year 3, we would take the 25,600 times 20%, which would then give us 5,120. We would then minus 5,120 from the 25,600, which would then give us our final answer, which is 20,480. Some terms to know when it comes to depreciation. Cost of asset. The cost of asset is the purchase price plus any expense required to get the asset ready for use. The salvage value is the estimated residual value of an asset at the end of its useful life. The book value is the asset's value at the start of the year. We already know two of the methods used to calculate depreciation, which is the straight line method, which the formula for that is the cost of asset minus the salvage value divided by the useful life. And we also know the reducing balance method, which the formula for that is book value at beginning of year times depreciation rate. But another method we can use to calculate depreciation is the total expected units of the production cost of asset minus salvage value times units produced during period.
Why is depreciation considered an expense? Depreciation is considered an expense because it reflects the allocation of the cost of a tangible asset over its useful life. Here are some reasons why. The matching principle. In accounting, expenses should be matched with the revenues they help generate. The asset value reduction. As an asset is used, it will lose its value. Depreciation accounts for this reduction in value, ensuring that the financial statement present a more accurate picture of the company's financial position. The financial reporting, by including depreciation as an expense, provides stakeholders with a clearer understanding of the company's profitability and the cost of maintaining its assets. The cash flow impact. Although depreciation is a non-cash expense, it reduces taxable income, which can positively impact cash flow in the long run.
So our company name is Zenith Workout Space. Our fixed assets are machines, building, furniture, protein snacks, merchandise. Machines cost is 15,000. The estimated useful life is 10 years. The salvage or the residual value is 3,000. For building, the cost is 20,000. Estimated useful life 50 years. Salvage slash residual value 4,000. Furniture, the cost 500. Estimated useful life 5 years. Salvage 50. Protein snacks, the cost is 1,000. Estimated useful life 1 year. The salvage 50. Merchandise 1,000. Estimated useful life 3 years. Salvage residual value 50.
Asset and depreciation methods. Machines, buildings, and protein snacks use the straight line method, the cost of the asset over its useful life. For example, a building that costs $20,000 with a useful life of 5 years, we're using a 4% depreciation rate. The annual depreciation expense will be $800. A survey The Belize Chamber of Commerce and Industry holds these assets that are straight up building, office furniture, fixtures, equipment, and vehicles. The method of calculation they mainly use is straight line method, and the factors that should be considered when choosing a depreciation method are type of asset. Different assets may be better suited to different depreciation methods. Useful life, the expected durations the asset will be in service. Tax implications, how depreciation impacts taxable income. Financial reporting requirements, the alignment with accounting standards, the industry standards, practices that are commonly adopted within the industry. By considering the type of asset, useful life, tax implications, financial reporting requirements, and industry standards, businesses can manage their fixed assets and stay aligned with regulations. Thank you for listening. By considering
Thank you for listening for our presentation. If you have any comments about or queries about depreciation, please leave a comment down below. And thank you. Have a nice day.